Chinmay is BA, MBA, and CMA, the qualification. He's a financial educator, business storyteller, international speaker, author. Since 2014, Chinmay has trained and consulted over 2,500 business owners and non-financial managers on the subject business finance, and over 10,000 students in Australia, India, China, and Indonesia. Chinmay is known for the research on hundreds of failed business to discover common finance mistakes made in business that he has presented to the Australian Taxation Office, the Institute of Chartered Accountants of India, Certified Practicing Accounts, CP, and various industry associations council. He has served as a national treasurer of Professional Speaker Australia between 2018 to 21, and he's an active Rotarian. He's a proud owner of 6 failed startup ventures. He's proud to have failed so many times as he prompted to find out the reasons why. He is a successful author, and I myself got an opportunity to go through his book, The Bottom Line, and the other one is Fundamentals of Financial Statements. So we'll be talking more on those lines, and I'll not take the thunder from you, Chinmay. So it's completely over to you.
Thank you. Thank you, Gladys ma'am, for having me and giving this opportunity to pay forward whatever I have learned in my journey as an entrepreneur and as an investor. Good afternoon, everyone. Just to make sure my audio video is working. Now, I'll not be sharing my screen. Everything will appear in this particular window. So maybe I would request someone to hit the spotlight.
It's perfectly fine.
Okay, thank you. Okay, quick question. Now, by the way, this will be an interactive session. I know it's post-lunch, and I've got a challenge in front of me just to make sure that you don't doze off. So how much is 1 plus 2 plus 3 plus 4 plus 5? Quickly type in the chat box, or feel free to unmute yourself. And others who are online, I would request you to kindly have the camera on, so that I could see some faces behind those names. It's always good to see some faces, facial expression, because as speakers, we derive a lot of energy looking at those facial expression. Well, it's good to see there is another Chinmay has got the video on. Hello. Thank you, Mr. Sadanand. Thank you, Vaibhav. Okay, great. Meanwhile, how much is 1 plus 2 plus 3 plus 4 plus 5? Don't tell me you're using calculators. 15. Yes, it is 15. Now, how much is 5 plus 5 divided by 5? 6. Okay. Any other answer? 6. Okay, I've got Harish in the chat box who has typed in 2. So is it 2 or is it 6? 2. Oh, okay. Anyway, neither I'm here to teach you arithmetic, which we learned back in high school, the board mass principle. The point I would like to make here is, for those of you who said 6, you said, you know what, 5 plus 5 divided by 5. First, I will divide 5 and 5. So 5 plus 1 is 6. And probably some other people who said it is 2. What you did was, you added first 5 plus 5, 10 divided by 5 is 2. As I said, neither I am here to teach you arithmetic or board mass principle. The point I would like to make here is, this is what happens when it comes to communicating using the language of business, that is numbers. If we take a step back, we decided to have this particular webinar at 3 o'clock on 7th of September. 7 number, no September 9th month in the year number, 3 o'clock number. I'm wearing specs, I know the power of my glass, numbers. I'm sure we had lunch, and according to our height, body weight, we decided what to eat, what not to eat, because we know the calories, vitamins, someone has calculated. Again, numbers. Sports, well, I hope we don't talk about cricket, but still, how will we know who's winning or losing? Looking at numbers. Weather, numbers. Politics, how do we go about electing the next government? Number of votes. Engineering, everything to do with numbers. The point I'm trying to make here is, if you carefully observe, almost every decision we make in our life is directly or indirectly related to numbers. Unfortunately, when it comes to business, because of the misconception and perception we have around numbers, we tend to shy away from numbers, and we say, I'm a non-finance person, or I'm a very technical person, I'm a very creative person. And then we end up making decisions based on gut feel or assumption. Now, I would like to ask one more quick question. What comes to your mind? What comes to your mind when you hear the word finance? Now, I've shared a quick link in the chat box. Probably, everyone who are in that particular seminar room, one of you can type in. You can type in up to 3 answers. So what are those words that comes to your mind when you hear the word finance? Now, don't type it in the chat box. Click on the link that I've just shared. And let's see what are some of the words that comes to your mind when you hear the word finance. Okay, calculations, crypto, boring, numbers, money, stock. What else? What are those words that comes to your mind when you hear the word finance? Metrics, capital, tax, cash flow, again numbers. See, one simple word, finance, and these are the words that comes to our mind. And then, of course, there's many more that is coming up here, growth, stock, so on and so forth. So the point I'm trying to make here is, whether we like it or not, world runs on perception, not reality. And unfortunately, the kind of misconception and perception that we have around the subject finances, we think we are a non-finance people. And that is the first misconception I would like to break, simply because we are all finance people, simply because we all make decisions in our business, and that decision will impact the bottom line. The question is, are we aware how our decision is going to impact the bottom line? Again, let us take a step back. Now, I enjoy educating people on the subject finance by comparing it with any sport. I'm sure you play some kind of sport, or you have played some kind of a sport, cricket, football, badminton, doesn't matter. To play any sport, we need to know 2 things. One, we need to know the rules of the game. And in business, we call it compliance. So we have our accountants, chartered accountants, lawyers who ensure our company, our business, our startup will abide by the regulation, tax office, whatever norms, and we abide by the rules and regulations set by those department. Back to the game, any sport. While we are playing the game, we make decisions, whether should we play aggressively or defensively. While playing cricket, should I take a single or should I hit a 4? So how do we go about making the decision? It is by looking at the score, which is numbers. It is depending on the situation, again, numbers. So now my question is, in business, in your startup, in your business, in your organization, are we making decisions by looking at the scoreboard, by looking at those relevant numbers? Or are we making decisions based on gut feel? And that is what today's session is all about, giving you a glimpse of what are those critical numbers an entrepreneur, or in many cases, an entrepreneur would like to know. Now, quickly, I would like to know who's on this particular webinar. If you have your own business, if you're a startup, then quickly type in an entrepreneur or startup. Or if you're working for a company, then probably you can type in professional, or if you're a student, you can type in student. Quickly, for me to just understand who, not to whom am I addressing, so that accordingly I can tailor make my presentation. Maybe Gladys, quickly let us know who's in the room.
So the people who are there in the room, they all are like company owners. They all own a startup.
Awesome.
So everybody here in the room is a startup. So there are outsiders as well who have joined. Many of them are just thinking about starting an organization, and many are in the pipeline.
Awesome, awesome. Good to know. And meanwhile, Sabina has said she's startup, Satvik startup. Kaushik is a student planning to have his own startup, entrepreneur, an accountant. So now Suresh who would like to have be a startup. Chinmay is a professional working. Okay, great, awesome. So in that case, I will try to focus and look from a startup perspective. Now, I have been interacting with a lot of my mentors, business coaches. So one thing that I consider myself to be really lucky is I've had so many people in my network who are entrepreneurs, who have been highly successful investors, mentors, business coaches, and a Harvard professor in finance, Professor Vinay Shawnee, who organized the seminar where me and Gladys met. Now he has given the foreword for my book. So after interacting and picking brain of all those experts, I wanted to kind of condense pretty much whatever happens in a business, and then try to explain it in one simple sentence. And this is one sentence I would like all of you to complete. I would like you to answer this. If our client or customer gives us dash rupees, if our client or customer gives us dash rupees, we or I will give them dash. So do you give them a product or do you give them a service? That is what we are doing. Either we sell a product or service, or sometimes we sell product and offer service to that product. I mean, service to that particular thing. So broadly speaking, only three types of businesses: business that makes money by manufacturing a product, manufacturing sector; business that makes money by offering some kind of a service; and business that makes money by selling a product, offering service to that kind of wholesale and retail. So if our client or customer gives us dash rupees, we or I will give them dash within dash period. So this is more about how do you go about delivering it? Is it something immediately you can give, or is it something that you take time? So who can complete this sentence? Maybe you can type those three key words. Or first is number and the other two are words. Like, let me give you an example. If my client gives me, let's say, 400 rupees, I will give them a copy of my book, The Bottom Line. Well, if they purchase it from me, then immediately I can give it to them. If it's on Amazon, then probably Amazon will take whatever time it's going to take. So again, keep it simple. If at all you have got multiple products and services, stick with only one. Maybe someone in the conference room, if you could answer, that would be great. Followed by others who are in the webinar joining online, you can type it in the chat box.
Abhishek. Abhishek is going to answer.
Yes, Abhishek.
Yeah. So if our client or customer give us 5,400 rupees, we or I will give them a smart band within 36 hours.
5,400 and you will give them smart band, is it?
Yeah.
Okay, within 36 hours. Awesome, great. Maybe one more. I've got Suresh who has typed in, who has said, if someone gives him 50,000 rupees, 3D printer within a week. So do you sell 3D printer, or is it something that you kind of use a 3D printer to deliver whatever the customer has ordered? Suresh, I believe it's the second one.
We are manufacturing 3D printers, sir.
Oh, you manufacture 3D printers?
Yeah. We are domestic manufacturer.
Awesome. Good to know. So now, even though it's a simple sentence, I've spent almost 3 years working on this and really condensing it to these three simple lines. Here are keywords. The first keyword is client or customer. Who is your client or customer? Who is that person? Where is that money coming from? Is it directly from the customer's pocket? So are you in a B2B business, B2C, B2G? Now, again, this is not a session on marketing or sales, but however, one of the critical number that we need to know when it comes to who our customer is, what is the cost of acquiring that particular customer? That's first critical thing that we need to know. And then if that customer gives us dash rupees, now for Suresh, it is 50,000, for Abhishek, it is 5,400. How did you come up with that number? I hope that you have done a bit of costing analysis, and I hope that you know your profit margins. And do you know how much smart band you have to sell month on month to hit that break-even point? Now, with regards to the 3D printing, how much do you have to sell? Now, what's the contribution? What's the margin? What's the profit margin? Now, when we say profit, which profit are we talking about? Gross profit, operating profit, net profit? Because many a times this is the challenge. People say, you know what, the profit margin on this particular product is 30%. Which profit are we talking about? Gross profit, operating profit with depreciation, without depreciation. So this is where now 5 plus 5 divided by 5, someone will be saying 6, someone will be saying 2. So again, a lot of critical numbers to understand when it comes to pricing, costing, and understanding the margins. The next critical thing to know is it only me or do I have partners, and are we running a business or a practice? Now, if at all you're doing something for the sake of doing it, you're having fun and you're not charging and things like that, no, you're actually, it's a hobby. Practice, what's the difference between practice and business? Practice is person dependent. Business is process dependent. So if Abhishek's business, if Suresh's business can run in spite of their absence, then yes, they're running a business. Whereas in my case, most of my service, it's a practice. Doctors practice, architects practice, accountants practice, lawyers practice, because if they stop practicing, then revenue stops to a great extent. So are you running a practice or are you running a business? It's not about right or wrong. It's all about understanding the pros and cons of each of them. And then we will give them dash. So either you're selling a product or you're selling a service. Now, smart band, it's a product. 3D printer, it's a product and then offering a service. Obviously, one of the things customer will be asking is why you and why not someone else? Why should I buy this smart band and not some other smart band in the market? So for that, again, we'll have to figure out the real cost of doing this and delivering it. And finally, it comes all to the delivery, which the critical thing that one needs to understand is when it comes to time, it's about cash to cash cycle. How efficiently and effectively can we keep rotating our inventory? Now, Abhishek, quick question. These smart bands, do you manufacture it or have you outsourced it and then you put a white label on it?
We manufacture.
So you manufacture, which means you have to source raw materials. You have to
Yes.
convert the raw materials into finished product. And that finished product has to be sold. And do you sell it directly to customers or to other business?
Directly to customers.
Direct to customer. So in that case, it's like cash and carry business. So which means the more and more cash to cash cycle is reduced, the better it is. So that's another critical number one needs to understand. So let me just give a glimpse of all of this from a high level perspective, because I know I'm mindful of the time. We've got another 40 minutes left. Now, you don't have to wait till the end of the session. In case if you have got any question, feel free to stop me or you can type it in the chat box. We'll be more than happy to continue the conversation. Now, I'm happy to stay even after 4 o'clock if required, but I definitely want to respect time and would aim to finish the content that I have prepared before 4. Great. So let's start with the cost of acquisition. Now, we have the customer. Now, initially, when you graduated, probably you wanted to work somewhere in a business, or once you started your own startup, your business, you wanted to sell your product or service. So that side people, now when we are selling something, we are offering a service, all we are saying is, hire me, give me a job, give me a business, pay me. And let's say these are our potential employers or our client. And what are they thinking? What is that question that will be running in their head? It is all about why you and not someone else? Why you and not someone else? Because there is always this invisible gap between a buyer and a seller. And how do you think this gap can be reduced? Let me give you a hint. It starts with the word T. I can hear someone whispering something, but I am not sure what it is.
Trust.
Exactly, bingo. Trust. Once the trust is built, that is when someone is ready to reach out to their pocket and give that money in exchange for the product or service that you're selling. Now, obviously, we know trust is not something we can build overnight. You have to have that marketing, sales, brand building activity. So this is where you go about having something known as TPs, touch points. I'm sure most of you are aware of touch points. As I said, this is not a marketing or a sales session, but touch point is when our potential client or customer experiences our product or service through one of their senses. Either they hear about a product, they see something about what we do, they touch it, they feel it, they taste it. That's a touch point. And intention of one touch point is to ensure it takes our potential client or customer to the second touch point, to the next touch point. Website is a touch point. Business card is a touch point. If at all you're having a stall in marketing, that's a touch point. If you're promoting it on Facebook, pay-per-click, it's a touch point. Now the question is, do you know how much are you spending? And how much does it really take for you to acquire that particular client? That's cost of acquiring, cost of acquisition. And that's a critical number that one should know. Now, another thing that you should be asking yourself, are your customers one-off or will they be coming back again and again? Are they recurring? If it is one-off, then probably the cost of acquisition should be included and ensuring that you have got substantial gross profit margin on top of that. If it is recurring, then some of them might say, you know what, I don't mind spending more in acquiring a client because I know that person might come back and buy from us another 2 or 3 or 4 times. So do you know that critical number, cost of acquisition? Now, before I continue, any question, anything you would like to ask or share? I will take that silence as a no. So let's continue. Now let us look at the margins, the profit margins. Now, let us say you decide to open a cafe.
Like I have a small query. So on the
Go for it.
cost of customer acquisition, your dealership cost doesn't come under it, right?
So when you say dealership cost, can you please elaborate on that?
Like the money you spend for your distribution setup. I mean, the difference between retail value and the value I give it to the dealer. So there is some margin.
No, you're not acquiring a customer here. So it's a margin that you're going to have. It's like a markup that you're going to have. So no, it will not be included in customer acquisition.
Yeah, that's it.
Okay, great. Now coming back to this cafe, let's say you decide to start a cafe. The reason I use a cafe as an example is simply because at some time when we were in a cafe, I'm sure we would have given a wild thought. I wonder what it takes to start a cafe. Now you look around and there are like 20 customers. If these customers spend around 200 or 300 rupees, and probably this is what the turnover every day for this business is going to be, and we will do all those quick math. So somewhere I believe that now we are all familiar with a cafe. Let us say you start a cafe and this cafe has made sales of 10 lakh rupees. So sales is 10 lakhs. Obviously, it's sales, top line, revenue. All of that 10 lakhs cannot be taken out of the business and given to a business owner. So it has to be paid. It has to be distributed to many stakeholders. Can you please tell me who are those stakeholders? Who needs to be paid from this 10 lakhs? Feel free to unmute yourself, or you can type it in the chat box. People in the conference room, now you can shout out.
Cost of space, I mean land or rent, asset order.
Oops, sorry. Where did it go? Yes. I heard someone say, okay, sales, this business has made us 10 lakhs. Who needs to be paid?
Rent, I mean rent of space,
So you have
infra
to pay that.
cost, assets.
Oh,
Employees.
assets. Okay. Okay. Rent, you have to pay salary.
Man, why operations?
Who else needs to be paid?
Material, raw material for the cafe making.
So pretty much suppliers needs to be paid. Yes.
All fixed costs.
All fixed costs. So probably we'll call all of this as fixed cost. Rent, salary, utility bills. So all the operating of fixed costs. And then we have suppliers, which will be raw materials. We call it as variable cost.
Advertisement and marketing. If anything.
Advertisement, marketing, we kind of will put it under fixed cost or operating expenses. Who else needs to be paid?
Bank and
Taxation.
Yes, you'll have to pay the banker if you have taken loan. You have to pay
Cost
interest.
of capital.
You'll have to pay tax. Now, when I say tax, I'm not talking about GST. I'm talking about tax that needs to be
IT.
paid on the profit. Who else needs to be paid?
Shareholders.
Finally, these shareholders.
That's when you make profit.
So owners, business owners. So we have 5 stakeholders here. Let's say fixed expense is A, suppliers is B, bank is C, tax government is D, and business owners, shareholders is E. Now, what should be the order of payment? Who should be paid first?
B is first.
Okay.
A is second.
Okay.
Then C is third.
Okay.
D is 4 and E is 5.
Okay. And E is 5. Anybody else who has got a different answer? Or you're slightly confused No, probably supplier should be paid later, or
No, like same. B and C both go hand to hand because the cost of capital is for your supplies.
okay, B and C goes hand to hand. Okay. In fact, no, Suresh, oh, I've got people who have been typing in answers. I missed that. Employees, fixed cost tax, water, electricity bills. Yeah, we have covered that tax. Yes. Satvik has said D, tax. Probably, Satvik, no, we're not talking about the GST when we say tax. So it's profit after tax. So depending on the profit business would have made, one needs to pay. And then you have said A, B. Okay, let's look into it. Obviously, the reason top line is called top line is because it's the topmost line. And then we pay the suppliers, also known as cost of goods sold. How much of cost, how much did it really cost to manufacture or produce or sell this particular product? If it's a service industry, we call it cost of sales. So revenue minus cost of goods sold will give us gross profit, GP margin. Now, in this case, it's 6 lakhs, percentage wise, it is 60%. So this is another critical number one should know. What is your gross profit margin on each and every product that you're selling? Is it 30%, 40%, 50, 60? Is it in par with industry norms? How about your competitor? Now, our family business, we manufacture carton boxes. There was a time when this gross profit margin was 30 to 40% back in 90s. These days, it is somewhere around 20% because there is so much of competition. Usually manufacturing sector, it's a volumes game. So the gross profit margin will be low. Whereas when it's IT, minimum investors would like to see is 60, 70, 80, sometimes even 90%, simply because I'm sure you all know better than me, technology becomes obsolete very soon. So every 1.5, 2 years, you will have to again come up with a new version of the software or new version of that particular IT related product. So a lot of R&D expense needs to be spent towards. So what's your gross profit margin? Do you know that? And have you compared it with your immediate competitor? And what's the industry average? After this, we pay all the operating expenses or fixed expenses. Gross profit minus operating expenses will give us EBITDA, operating profit. Earnings before interest, tax, depreciation and amortization. Now, if you're not familiar with these terms, please don't get too overwhelmed. Let us go one by one. Let us start with D and A, which is depreciation and amortization. I'll quickly tell you the why behind it, why it's done. Now, to make a cup of coffee, I'm sure to a great extent, we will know how much of coffee powder, how much of milk, how much of sugar will be consumed. You can measure it, quantity. However, we will also be using coffee machine to make coffee. Now, how can we associate a cost for this coffee machine? And this is where depreciation is the answer. Give me 1 second. I'll turn off the autofocus. I believe I thought I did. Sorry for that. Coming back to what I was saying, how do we go about associating the cost for this coffee machine? This is where depreciation comes into the picture. For that, we need to know 2 things. One, we need to know how many number of times this coffee machine can be used, or number of years this coffee machine can be used. Let's start with simple method, number of times. Let's say the coffee machine is worth 1 lakh rupees. And let us say 1,000 cups of coffee can be made. So 1,000 cups of coffee can be made, that's 100%. And let us say this business has used this coffee machine 100 times. So 10%, this is used. In other words, consumed. 10% of the machine is consumed. How many more times can it be used? 900 times, which is 90%. How much is 90% of 1 lakh? 90,000. So now 90,000 is the value of the asset. What happened to this 10%? This 10% is nothing but 10,000 rupees, and this 10,000 rupees is depreciation. Now, of course, it's very difficult to figure out in terms of units how many times a coffee machine can be used. Imagine heavy equipment. Imagine a taxi. Now, if you buy a bike or a car, and if someone asks, how many times are you going to use it? Probably you'll say, I don't know. It's very difficult to measure it that way. On the other hand, you might say, I might use it for the next 2, 3, 4, 5 years. You don't have to break your head. Taxation office every year, they give the depreciation value of each and every asset, and accountants ensure that they go about figuring out this depreciation value. But again, something that one needs to understand the why behind it. So in this case, let us say the depreciation value is 50,000 rupees. So in EBITDA, DA is taken into consideration. Depreciation is for tangible assets. Amortization is for intangible assets. Now we arrive at EBIT, earnings before interest and tax, which is 2 lakhs in this case. Now we are left with two things: interest that needs to be paid to the bank and tax that needs to be paid to the government. Should we pay interest first or tax?
Interest.
Definitely we have to pay interest, because if you pay tax, then you have to pay tax on 2 lakhs. That is why interest is a tax deductible expense. So whenever government announces this particular item is tax deductible, what they're saying is, go out there, spend money, because government wants more liquidity in the market. Go out there, spend money, help other businesses, let's have more liquidity in the market, and you show it as an expense. In turn, you end up paying less tax. So let's say interest is 25,000 rupees in this case. We arrive at PBT, profit before tax. And it is on this number, business is expected to pay tax. Now imagine if 50,000 rupees depreciation was not taken into consideration, what do you think would have happened? This number, profit before tax, would have gone up by 50,000, on which business was supposed to pay tax. Now, if tax is 30%, it's 52,500. Then we arrive at net profit, profit after tax, which is 1,22,500. Now, this profit after tax, net profit, to whom do you think it belongs to?
Shareholder.
Yes, definitely it belongs to the shareholders, but all of it cannot be taken out of the business. So 3 things will happen with net profit. 1, it gets reinvested back into the business, because the more you want to grow, the more you want to expand, the more Suresh wants to sell 3D printers, probably pan India. He might have to have different locations, different office. So more money needs to be reinvested. So either he has to invest from his pocket or borrow from the bank, or hoping that they're making a healthy profit, then it gets reinvested. So how much of this net profit is getting reinvested? Again, numbers. If you have borrowed loan, probably not from a bank, from a NBFC or a third-party loan at a high interest rate, unsecured, then some of them choose to pay that off.
Capital.
So again, second thing that happens with net profit is part of it gets repaid to reduce the expensive liabilities. The third thing what happens is part of it gets distributed among the shareholders, and that is what is known as dividends. So 3 things: gets reinvested, gets repaid most of those expensive liabilities, and in form of dividends, it gets paid. Again, how much of it are you going to pay these stakeholders is another critical question. So the 3 main profit margin one needs to know as gross profit, operating profit, and net profit. If I understand most of the startups, they are not making profit, they are kind of burning cash because they're in the game of valuation. In that case, we need to understand cash burn rate. So let's say for the quarter, January, February, March, in the month of January, the revenue is 1 lakh. However, expense is now here, overall expense is 1,50,000. So the difference is 50,000, negative 50,000. In February, let's say it's negative 25,000. In March, let us say it is negative 75,000. So average cash burned in this particular quarter is 50,000. So as a startup, most investors understand that you may not be yet profitable. So this is one question they'll be asking. At what rate are you burning the cash? And in which quarter you're burning it? So you should have all these numbers at your fingertips. Okay, before I move on to the next part, is there any question? Suresh has typed in difference between revenue and turnover. Revenue, turnover, sales, top line, different terms, same thing. And accountants,
But I have a question.
yes.
It's regarding the depreciation and amortization. So how do you whenever we're buying assets, like for example, some soldering stations or laptops for the company. So do you the part or how does it get?
Good question. Good question. Now, even this pen, ideally, even this is an asset, because what's an asset? Asset is something that you can use it over a period of time. But if even this pen worth 50 rupees or 100 rupees is entered as an asset, then accountants and bookkeepers know they'll be pulling their hair and they'll go crazy. So this is where taxation office will have a bracket. Now, I'm not sure what it is here in India. It might be 50,000 or 1 lakh, whereas in Australia, it's $20,000, which means, okay, for the sake of example, let us say 50,000 rupees. So if you buy any item that is worth less than 50,000 rupees, you can straight away show it as an expense. So laptop, if it is worth less than 50,000 rupees, you can straight away show it as an expense, even though you're going to use the laptop for a while. So this is something that you'll have to check with a chartered accountant. I don't have that latest number. Every taxation office will have a benchmark saying that, you buy anything, and if it is worth less than 50,000 or 1 lakh, depending on whatever that slab they would have come up with, you can straight away show it as an expense. I hope that answers your question. Now, meanwhile, Aisha has typed in saying to calculate cash burn, the expenses include tax, interest, etc., or just costs and operating expenses. Now, Aisha, when you say tax is something you pay on profit. If business is not making profit here, then obviously they'll not be paying tax. Interest, yes, it is included. Interest, it's an expense which is included here. Cost of goods sold, yes, it is included here. And yeah, obviously operating expenses, it's included here. Okay, so let's continue. Let's look at the real cost of capital. Now, this is one thing that I keep emphasizing. First thing that we have to understand is you are not your business. Let's say that's you, business owner, always running around, super busy, and let's say this is your business. You have to make it very clear to yourself that you are not your business. Treat your startup separately and yourself separately, mainly because of two reasons. Reason number one, imagine there is a newborn baby and you ask the parent of the baby, hey, which is the most beautiful baby in the world? What do you think the parent is going to say? Of course, my baby is the most beautiful baby. Imagine an arrogant man like me. I look at that baby and I go, ooh, that's an ugly baby. How do you think the parent is going to feel? They'll feel sad, they'll feel bad. No, it's like there'll be so much of anger and kind of negative emotion, simply because there is so much of emotional connection between the parent and the baby. Unfortunately, we bring in the same emotion even to our business, even to our startup. We say, this is my business idea, this is my startup, this is my baby. Hello, what are you going to do with your baby? You have to take it to the market. You have to sell your product or service and you have to sell it in the market. And do you think market will be so sympathetic and empathetic and kind enough to say that, oh, you know what, I don't really like your baby, probably they'll say, I hate your baby, I don't like your baby, I don't like your 3D printer, I don't like your smart band, I don't like your book. How are you going to take that criticism or feedback? If you take it personally, I'm afraid you're treating your business or your startup as your baby. Instead, detach. Tell the world, hey world, this is me, business owner, entrepreneur, startup founder, whatever you want to call yourself. And this is my startup idea. This is my business. Collectively, how can we make sure we can improve this product? That will help you to be more agile and deliver a product or a service where market will see value. So that's one of the reasons. Second reason is there are only four things that can happen in any business, Small, medium, large, it doesn't matter. If there is one thing that I would like all of you to take home from this webinar, if there's one thing, it is these 4 things. Ready? Money comes in. Money goes out. Money supposed to come in. Money supposed to go out. Full stop, period. That's it. These are the only 4 types of financial transactions that can happen in any business. Money comes in, money goes out, money is supposed to come in, money is supposed to go out. Collection of such, all these 4 financial transactions is what we call accounts, which bookkeepers, accountant will enter on one of the softwares, accounting softwares, Tally or QuickBooks or Xero or whatever we have these days. And then financial reports are prepared. These 4 financial transactions are always recorded from business perspective, not from business owner's perspective. So now, to start a business, grow a business, expand a business, what are some of the resources that are required? Quickly shout out. What are some of the resources that are required to start, grow, expand any business?
Human resource.
Human resource.
Product or technology.
Product, technology, okay.
Infrastructure.
Infrastructure. Aisha has typed in capital. So as we are kind of running out of time, all the resources that you have said and many, many, many more, all of them can be brought under 2 headings: financial capital and intellectual capital. Financial capital is all about how will the business go about getting its funds? Where will it get the money from? Intellectual capital is about the know-how, knowing how to convert a raw material into a finished product, knowing what kind of human resource we should be having, knowing what way to sell, what to sell. It's all about intellectual capital. Now, when it comes to financial capital, business borrows money from 2 types of people. Whenever business needs money, it borrows, and it borrows from 2 types of people: insiders and outsiders. Insiders are you, business owner, startup founder. This is where many people go, Chinmay, what do you mean my business is borrowing from me? My business is in my name. I have registered in my name. I'm the only sole proprietor of this. It doesn't matter. And this is where, let me remind you, you are not your business. Business should be treated separately. Business owner should be treated separately. Looking from business perspective, business borrows from insiders, and insiders are business owners, business partners, investors, shareholders, and the 3 famous F's: family, friends, and fools. And then it borrows money from outsiders, like a bank. Now, business will not always borrow physical cash. It might also borrow raw materials and services from suppliers to manufacture that smart band, to manufacture the 3D printer. I'm sure you're procuring raw materials from your supplier, and that supplier is not asking you to pay money immediately. You might have negotiated where you'll be paying them after 15 days or 30 days or 45 days, credit term. Looking from business perspective, business has not borrowed money, but it has borrowed in kind. So business borrows financial capital and intellectual capital, and either it makes money by selling a product or service, or both product or service. Aim of the game is simple. We should make sure business is selling product or service for more than it is costing the business. To know if we are selling a product for more than it is costing, we have to understand that side of the equation. And this is where we prepare balance sheet. I'll give you a quick crash course on what's on a balance sheet. As I said, you are not your business. Business should be treated separately. Business owner should be treated separately. Business borrows money from insiders and outsiders. Quickly, what are the 2 main headings on a balance sheet?
Assets, liabilities.
Liabilities and assets. I'm not a huge fan of using all this jargon. Liabilities is nothing but sources of funds. Business, where have you sourced the money? Business has sourced money from insiders. Insiders' money is known as capital. If it is more than 1, we call it share capital. What do we call the money borrowed from the bank? Loans. So insiders' money, outsiders' money, it's a liability. It's a source of funding. It's sources of funds. Now, why did the business borrow money? Because you wanted to use it somewhere. You wanted to purchase land, building, equipment, machines, so on and so forth. So assets is nothing but users of funds. Under that, you have fixed assets. Now, we understood business will not always borrow cash. It will borrow raw materials and services on credit. So that gets recorded under liabilities as current liabilities, payables, current liabilities. Currently, business is liable to pay someone within the current financial year. anything that needs to be paid, either to suppliers, either to, again, no GST payable, any short-term loans, money that is supposed to go out within the current financial year, we call it as current liabilities. Similarly, under assets, we have current assets, mainly made of three things: debtors, who are none other than our customers; receivables. So we have payables under liabilities, we have receivables under assets. Debtors are people who have purchased, who have bought your product or service and they're yet to pay. Let's say Mr. Suresh, no, he decides to sell his 3D printer to through a retailer, and he will send 10 of his 3D printer. Immediately, the retailer will not pay. He will say, Sureshji, I'll give you money once we sell it. So there might be 30 days, 45 days credit term. Money is supposed to come in receivables. Then we have inventory, either raw materials or finished goods, and finally cash in hand, cash in bank. Anyway, I didn't want to emphasize more on balance sheet, but this is something very critical for you to understand, because we have to understand the cost of liability. Let us just start with you, an entrepreneur, and let me ask you this question. How much should an entrepreneur, business owner, startup founder should aim to earn in their own business? So as a business owner, how much money should you aim to earn in your own business? Give me some number. How much would you like to make in your own business? Kaushal has typed in sky is the limit. Unfortunately, sky is the limit is not measurable. Satvik is saying 7 lakhs. Okay. Mayank is saying ROCE should be at least 50 to 70%. So ROCE is return on capital employed. Capital employed in this case is both insiders' money and outsiders' money. Share capital plus loans. Suresh is saying 10x. Okay, interesting. Anybody else? Now, this is my rule of thumb. As a business owner, as an entrepreneur, as a startup founder, we should aim to earn at least minimum 5 times our market value as an employee. 5 times our market value as an employee. And let me tell you why. So here is the business. Now, either we can work in the business as a business owner, or we can be part of a business or a company as an employee. As an employee, what is that we are trading with this business? We are trading time. And we are trading our talent, experience, expertise. And for that, we are getting paid a salary. As a business owner, what are we trading? We are trading time, we are trading expertise. In fact, we are trading more time. For that, is business paying you a salary to start off with. And it's not just time, you're also investing your money. You're putting in your capital, you're taking risk. So what is the reward on your investment? Most of them, they don't look at this from this perspective. They're like, you know what, it's my money, I've got 5 lakhs savings, I'll probably borrow another 5 or 10 lakhs from my parents and I'll start this business. If it works, it works. Well, again, I'm no one to say whether it's a right approach or a wrong approach. All I'm trying to convey here is, if we don't have clarity with regards to what is that we want to achieve, then how are we going to achieve it? If we don't know what we want, then the chances are probably we'll not get what we want. So coming back to what I was trying to convey, why we should aim to earn 5 times our market value. Let us look at some of the numbers. So we have employee and we have business owner. Now, our employee usually works Monday to Friday, 9 to 5, 9 to 6. And let's say the take-home salary is 12 lakhs per annum. Business owner, do you think a business owner works Monday to Friday, Monday to Saturday? They will work Monday to Monday. Do you think a business owner works from 9 to 6? Probably they'll work from 7 to 11, 7 a.m. to 11 p.m. And on weekends, they're really busy catching up with the backlogs. And on top of that, you sacrifice your family time, your health, your personal time, and you have to ensure you pay your landlord the rent, you have to pay your employees the salary, you have to pay your suppliers all the dues, you have to pay the utility bills, you have to pay the bank the interest. And if at all you're left with something, you can take home something with you. And if you're not clear with that, then oops, I don't know what might happen. And on top of that, regular headaches, occasional heart attacks. Don't you think you deserve to earn more than what you would have earned otherwise as an employee? So this is where my rule of thumb, at least it has to be minimum 5 times. So it is 60 lakhs. Now, some of you might be thinking, come on, Chinmay, be practical. How can I expect to earn 60 lakhs in the very first year or after a few years? Now, this 60 lakhs in this example is something we aim for. In other words, it's a belief. I'm sure tomorrow morning, if you decide, I'm going to go for a jog and I will jog 4 rounds. The chances are you might jog 2 or 3 or 4 rounds. Very rarely, you might jog 4.5, 5 or 6 rounds. Because that 4 rounds, that number 4 was your belief. That is what you aimed for. My question is, what is that number that you want to aim for to earn and take home for all the risk, for all the investment, for the kind of time that you're spending? Now, here's the magic number, 2162. This is the average number of hours an employee works in a business, 2162. So 12 lakhs divided by 2,162 is 555. So hourly rate of an employee is 555 rupees. But for a business owner, this hourly rate will be 2,775 rupees. If you are doing any work and you think that work can be done by someone by paying he or she 100, 200, 500,000 rupees, then it's better to get that person doing it. Otherwise, you will be running a practice, not a business. It will always be person dependent, not process dependent. It will be very difficult to expand, scale, and grow because everything will revolve around you. You might derive a lot of pleasure that pretty much I'm the decision maker in this and I'm so busy. But are you really growing and expanding? Because that is what an investor will look for. Now, when me and Gladys ma'am attended the conference in Delhi, that was one of the things a VC was saying. The moment we come to know this startup is dependent on 1 or 2 people, it's not scalable, it's a red flag, straight away we reject it. Another critical number one should know. Now, why 5 times? Let me tell you. Now, first year, if you continue to work as an employee, probably you would have got 12 lakh rupees as a salary. And we know 60% of the businesses fail in the very first year, the remaining 90% in the next 3 to 5 years. Now, neither I'm here to demotivate you or scare you. All I'm trying to say is, if you decide to enter a playground to start your startup, the chances of survival is very less. So it's better to be prepared and enter the playground. Warren Buffett said, a fool with a plan will always defeat a genius without a plan. So it's better to sit on the fence and plan accordingly and understand, because it's very easy to enter the play field, but very difficult to come out of it because you don't know when you want to come out of it. And then you'll be going through all those Instagram and some social media. And here is an entrepreneur who's saying, don't give up, never give up, and giving all those pep talks. And you're like, yeah, I'll push harder, I'll push harder. Forget about money. Money is unlimited in this world, but your time is limited, which you can never get back. So rather spend some quality time doing a bit of a research, have a mentor, have someone with you bounce ideas, and then decide what baby you want to take to the market. So let's say your business survives, your startup survives, and let's say your take home was 3 lakhs. So you take a little bit of salary, so maybe if your business is making profit, whatever, all put together, let's say you took home 3 lakhs. This is not sales. This is what is left for you, 3 lakhs. You had an opportunity to make 12 lakhs, but you only made 3 lakhs, which means the opportunity cost in this case is 9 lakhs. Second year, let's say that 3 lakhs became 6 lakhs. Still, it is negative 6 lakhs. Third year, let us say it's 9 lakhs. Still, you're negative 3 lakhs. Fourth year, let us say you are kind of in par to your market value as an employee. Now, usually research says it takes anywhere from 5 to 7 years to run a crore or a 5 crore or a 10 crore business. Probably your employee, your market value as an employee after 5 years would be, I don't know, 15 lakhs, 20 lakhs, 30 lakhs. But your opportunity or the potential to earn as a business owner, there is no limit to it. As Kaushal said, sky is the limit. Now, probably you might make 20 lakhs or 1 crore or even 100 crores, or you might exit big, after building a unicorn at 500 or even $1 billion kind of a thing. And this is the reward we should aim for taking that leap of faith. But my question is, when you took that leap of faith, did you have this in the consideration? Or are you just running and being busy for the sake of being busy? So another critical number one should know. And just mindful of the time, we have got less than 2 minutes before 4. Is it okay if I continue for another 5 more minutes, Gladys ma'am, with your program?
Yeah, absolutely fine.
Okay, because we kind of started 5 minutes late.
Yeah.
So this is what we should aim to achieve. Now, I touched upon a bit of cost of acquisition, the profit margins, and then didn't really go through cost of capital, but at least one should know how much you would like to earn. Now, when it comes to product life cycle, one has to figure out it's a different session by itself, and then cash to cash cycle, different session by itself. However, I just want you to understand the why behind it, the importance behind it, and you can go out there. I'm not trying to sell my book, but if you want, you can read my book or watch my videos or ask Professor Google. There will be hundreds of videos. But again, it's not just about what and how. Try to understand the why behind these critical numbers. So as I said, this is one thing that I would like to leave you with. 4 financial transactions that happens, money comes in, goes out, supposed to come in, supposed to go out. Whenever money comes into the business, let us say this is your startup. How do you think money will come into the business? In what form? Investment. So that's borrowings, and it will come into the business in form of income, sales, revenue from customers. So borrowings is nothing but liabilities, which we saw on balance sheet. And this is something that we get from customers. Whenever money goes out of the business, only 2 things will happen. One, it will become an expense or it creates an asset. You pay rent, it's an expense. You pay salary, it's an expense. You purchase a laptop, well, depending on the bracket, it will be an asset. You purchase a machine, it's an asset. So whenever money goes out of the business, either it becomes an expense or it creates an asset. Again, the question is, how much of it are you spending towards expense, and what kind of return is it going to give? How are you going to justify that expense? And if you're investing in a machine, some asset, what kind of return that asset is going to give? In the first place, is it a performing asset, non-performing asset, or not at all essential asset? Again, numbers. These are some of the critical things that one needs to understand. So let me end with this particular slide. I usually enjoy educating people on the subject finance by having some element of fun. And my title of the first book was Fundamentals of Financial Statements. Let us try to understand finance by comparing it with the game of football. Football, aim of the game is to score more goals than the opponent. In business, aim of the game is to make more money than they spend. In football, whenever someone scores, there is some action happening on the ground. There is someone who's recording it. We call them scorer. Whenever a financial transaction happens, and what are the 4 types of financial transactions? Can someone quickly shout out, please?
Money goes out, money is supposed to come in, money is supposed to go out.
Oh boy, I felt like a school teacher. Yes, money comes in, goes out, supposed to come in, supposed to go out. Whenever it happens, it gets recorded. What do we call that person who records this?
Accountant.
In India, we call them accountants, but the technical word is bookkeeper. Bookkeeping. So they're known as bookkeepers. But again, in India, if someone does commerce, they have graduated, commerce graduate, they know how to use tally, then we call them accountants. Technical word is bookkeeper. In many startups, in many small to even medium scale businesses, this is a big issue. Simply because either they don't have a dedicated bookkeeper or books are not up to date. Ask yourself, if the scorer is not scoring the goals properly, will we know who's winning or losing? Then if we don't have books into account up to date, how will we know the decisions that you're busy making is bringing in profit or not? In football, there is someone called as a referee. What is the role of a referee? To make sure everyone abides by the rules of the game and there is a fair game played. This role in business is played by accountant. In this perspective, it is chartered accountant. Accountant count They count the financial transactions, then they ensure business abides by the regulations set by the taxation office. Now, have you ever seen a football player asking the referee, where should I kick the ball or how should I go about playing the game? Then why is that we have this perception that we need to be dependent on accountants or some financial expert to tell us how to make financial decision? Finance is not accounting, accounting is not finance. They're two different things. No offense to accountants, but they're amazing people. But what they do is ensuring that they take care of the books and they make sure your business is compliant.
As per rules.
As per rules, what happens after that is finance. This is where I mentioned at the beginning of this session. Non-finance person is a myth. Non-finance manager is a myth. Non-finance business owner is a myth, because you make decisions and your decision will directly or indirectly impact the bottom line. But the question is, do you know how it is going to impact the bottom line? Because in the game of football, before the player kicks the ball, they know the score, they know the situation. Accordingly, they decide either to play aggressively or defensively. They make decision in such a way so that it helps the team win the game. The decisions that you are busy making in your business, in your startup, do you know how it is going to impact the bottom line? And this is what finance is all about. Are you running your business? Are you making decisions in your startup in such a way that it is going to impact the bottom line in a positive way? Or are you blindly kicking the ball because someone asked you to kick, or you saw someone kicking and you're kicking and running and being busy for the sake of being busy, without having absolutely no clarity on how it is impacting the bottom line? In football, a team wants to be on the winning streak. They want to win the championship. Now in cricket, I think probably India is out of the Asia Cup, but they went there to win the championship, right? So same thing in business. You don't start a startup to make profit once. You want your startup to be profitable sooner or later. So for that, you need to have a few P's in place: people, price, process, product, and the list goes on. All the departments. It's not everyone needs to be on the same page. It's like in the game of football, you have the goalkeeper, you have the defender, you have the midfielder, you have the forward. Everyone needs to be on the same page. In your business, as of now, as a startup founder, you might be an all-rounder, and slowly, eventually, you start delegating and you get more and more people working for you. Do they know when they make decisions how it is going to impact the bottom line? Many a times people say, you know what, my department KPI is this. I've ticked the boxes, my job is safe. They expected me to achieve 25%, I've achieved 20%, all good. They fail to understand overall how it impacted the bottom line. Finally, where? This is what we are doing, whether in life or in business. I am here, I would like to go there. As simple as that. We make 1 crore, I would like to make 2 crores by the end of financial year. Morning 8 o'clock, I am here at home, 9 o'clock, I would like to go to office. The question is how? But most of the time when we say here, we always express business from revenue, sales, turnover perspective. The turnover of this business is 1 crore, 10 crores. Business is not just about turnover. It is more about leftover. It is not how much we make. It is more about how much we keep. For that, we need to understand this number, PBT, profit before tax, which we saw on profit and loss statement. Then we need to understand, why is this business still here? Why is your startup, why is your business making 1 or 5 or 10 crores? For that, you need to understand how the business got here in the first place, what happened, what worked, what didn't work, and you start seeing a pattern will emerge. Common sense is, let's do more of what has worked. If we are doing something we haven't done before, do we have plan B, plan C? Are we taking calculated risk, or are we gambling with this? Again, no, I tell people, no, finance is a common sense subject. Well, unfortunately, common sense is not very common, which I try to keep reminding people. So we are here, we want to go there. Again, there is not saying let's double our sales. It doesn't mean anything until you know how the doubling of sales is going to impact the bottom line. Obvious question is how. How will you take your business from here to there? And I'm sure you will come up with n number of ideas and strategies. But my question is, do you know those ideas and strategies? How are they going to impact the bottom line? It's like you open Google Maps. It will say you are here and you will enter your destination. It will give you a route, 20 minutes. Imagine you miss an exit or a turn. Immediately it will reroute. That's plan B. Do you have something like that? Do you have plan C? If yes, then probably the chances of your startup being investable is very high because you have those numbers in place. Remember these golden words by management guru Peter Drucker, who said it back in 1980s. What gets measured gets managed. What gets measured gets managed. And what is that only thing we can measure? It is numbers. So these are the critical numbers that you have to know. So mainly in my last 8 to 10 years of playing this game, what I've understood is whether they are decision makers in small business or corporates or multinational companies in Australia, India, China, and Indonesia, what I've observed is these key decision makers would like to know three things at any given point in time. One, where is our business startup organization from? PBT, profit before tax, finance perspective. Second thing, why is our business still here? Third thing, the decisions we made yesterday, we took today, we are planning to take tomorrow, will it help our organization to go from here to there or here to somewhere else? For all of this to effectively function and for you to make informed, profitable decision, you have to understand numbers. So I would like to leave you with this. In case if you're interested, there's a quick Google form that I would like to share where I'll be more than happy to give you access to a basic program called Business Finance Essentials, 20 videos, which you can watch it at your own pace. Yes, I've just typed it in and it's 9 minutes past 4. Happy to hang around for some more time in case you have got any questions. In case if you have to leave, I appreciate, I respect your time. Thank you for joining and feel free to connect with me on LinkedIn, Chinmay Ananda. I'm sure you should be able to find if you have a mutual connection. Open for questions. And then at this stage, I would like to hand it over back to Gladys, ma'am.
All right.
So like very quick question.
Yeah.
So first thing, it was wonderful during the session. Lot of it as being one business owners makes sense. Very specific question in terms of as we do a mass scale production business versus any other form factor of business. How do we judge, let's say, Apple kind of business, electronics, where you have 60-70% gross margin versus an automotive business where the whole industry works at 20% operating margin, but obviously the scale, the positives, negatives are different. But if you look at finance, it's all about that PBT or what you exactly said. Even if you compare different industries, companies, is there any common parameter that you can judge?
See, it's not a parameter as such. Again, depends from whose perspective are you looking at. If you're looking from an investor's perspective, their main goal is to make sure their money makes more money. So they decide accordingly, where should I invest? Now, of course, every investor, if let's say I've got 1 crore, experts say don't put all eggs in one basket. So probably I would like to put 20-30 lakhs in some investment where even if the return is kind of low, I'm okay with it. And then I might take some higher risk. So that's a perspective of an investor. Because with all the EV thing that's happening today, it's a high risk. You never know which EV 2-wheeler or 4-wheeler will make it to the market and who might fail or get bought out. That's a high risk. If someone wants to invest, yes, they can invest. So there's no parameter as such, but that's a perspective of an investor. Now, as a business owner, now you have to ask yourself, this is something I learned from one of my mentors. You go to a forest, either you can hunt a deer or 100 rabbits or 1 elephant. Of course, I'm not encouraging you to kill animals, but the point I'm trying to make here is, do you want to sell, or let me give you another example. I'm sure most of you would have gone to McDonald's.
Yeah.
Have you ever gone to McDonald's or ever been to McDonald's and just bought 1 burger? It will never happen. Burger is a way to get client inside the door. The moment you get inside the door, they'll sell you with all the add-ons like fries and cookies and that sugar water. Burger is a way to get client inside the door, and the operating profit is 3, 4, 5% operating profit. But fries or cookies 3 to 4 times is the profit margin, and Pepsi or Coke, which costs them less than, I don't know, 5 rupees, I suppose, or even less than that, they sell it for 50, 100, 200, 300 rupees. Now, Abhishek, you said you sell smart band. So is that smart band like burger, fries, cookies, or sugar water? Or do you have an add-on to it? Can you package it? Can you bundle it? So all this needs to be taken into consideration. Now, maybe smart band is something that will pull people to your business. Can you sell something else? So even that needs to be taken into consultation. And this is again something that was discussed in the VC seminar we attended, me and Gladys, ma'am. Now they said, if you don't have a business where you cannot grow more than one product, then again, it's a big red flag. It's a fatal flaw.
So in that perspective, if you look at the investor angle where it is, you have like 1 CR, you want to use it as a working capital for Apple kind of margin business or Tesla kind of margin business. Not Tesla, but any other traditional company which typically runs at 20% gross margins. Because I'm ideally directly comparing my business, which is into automotive, versus any hardware electronics, which is similar to Apple, where the entire industry works at 60-70% growth.
See,
But
again, because you've taken example
from the investor perspective, he has 1 CR where he needs to put in what I can offer differently to.
See, end of the day, again, something that was discussed in that seminar is capital follows talent. Do you think Steve Jobs was talented? In terms of marketing, sales, oh boy, he was. Technically, not really. No, Steve Jobs, with what I have read and understood, he did not know how to manufacture a computer. It was Steve Wozniak who knew how to do it. And we had a person called Mr. Tim Hendricks in Delhi, who worked with Elon Musk for 3 years. And he said, Elon Musk is not an expert in anything as such, but he's so inquisitive and curious that he knows how to get the best out of whatever he's going to manufacture and produce. So these are people who are highly talented, and obviously capital follows. Now, why comparing all those American entrepreneurs? Why not Kunal Shah? Great, everyone. Before it automatically switches off, thank you so much. Thank you, Gladys ma'am, once again for giving the opportunity.
Thank you very much, and have a great time. Thanks, Chinmay, for
Thank
your
you
time.
so much.
Have
Take
a
care,
wonderful
everyone.
session.
See you then.
Thank you.
Bye.
See you.